With the U.S. markets now closed for the weekend, we are looking at the final critical figures from Friday, November 7th, 2025 for Plug Power Inc., ticker PLUG. The stock finished the session at $2.65, a significant pop of 5.58% on the day. That momentum continued in the after-hours session, with the stock adding another cent to $2.66. But that 5.58% jump isn't just another day of wild volatility for this name. It happened on staggering volume of over 100 million shares. This wasn't a quiet drift up. It was a desperate, high-stakes repositioning by the entire market. The reason is simple. This is the last day of trading before the company reports its third quarter 2025 results, which are scheduled to drop on Monday, November 10th. That 100 million share volume is the sound of a coiled spring, with speculators and short sellers making their final bets before what could be the single most important earnings report in the company's history. The immediate expectation for a $2.65 stock with this kind of history is that it's a gamble, a broken company on its last legs. But the reality is that the entire narrative for Plug Power was fundamentally reset earlier this year. And Monday is the first time management has to prove that the new story is real. The common belief, and it's an easy one to have, is that Plug Power is a going concern risk. It's the stock that has haunted the Robinhood app portfolios of countless retail investors. For the past 2 years, the narrative has been one of catastrophic cash burn, disastrously negative gross margins, at one point dipping below negative 60%, and the looming existential threat of bankruptcy. The market has viewed it as a company with a great idea, but a hopelessly broken business model, a black hole for capital. This is the expectation, and it's why the stock is at $2.65 and not $26. But to challenge that thinking, you have to understand that this is, in many ways, a completely different company than it was 1 year ago. The two company-ending existential risks that define the bear case have been resolved. First, the U.S. Treasury's final guidance on the 45V hydrogen tax credit, released in January 2025, was a massive win. It allows for annual matching of green energy until 2030, not the impossible-to-meet hourly standard the market feared. This guidance is what makes Plug's green hydrogen plants, like the one in Georgia, potentially profitable, offering up to $3 per kilogram in credits. Second, the $1.66 billion loan guarantee from the Department of Energy is not a maybe anymore. It closed in January 2025. The capital is secured. The old bear case is dead. The new bear case, and the entire reason for Friday's tension, is execution. Let's dissect this recent price action. That 5.58% pop to $2.65 is the final nervous jolt before Monday's report. This stock has been a war zone. In early October, it rocketed to a 52-week high of $4.58 after analyst firm H.C. Wainwright reiterated its buy rating with a $7 target, citing the new macro environment. But since that high, the stock has pulled back over 28% as the market's crippling fear of the company's financial discipline took over. That 100 million share volume on Friday is this conflict in real time. On one side, you have the bulls, the speculators using their SoFi Invest accounts and the Fidelity mobile app to buy into the $7 analyst target narrative. They believe the DOE loan and 45V credits are a massive backstop, and that the recent string of positive news, new electrolyzer deals in Uzbekistan and the Netherlands, a new CEO announced for 2026, proves commercial momentum. On the other side, you have the short sellers and institutional skeptics. They are looking at the Zacks consensus estimate for Monday's report, which projects another loss of 13 cents per share. They remember Plug's horrific history of missing every single earnings estimate for the last 4 quarters. They are betting that the company is still fundamentally incapable of controlling its spending, and that even $1.66 billion in government loans won't be enough to plug the hole. This isn't just a stock, it's a high-stakes bet on financial competence. So what does Plug Power actually do, and why is it so capital intensive? The company is attempting to build a vertically integrated green hydrogen ecosystem. This is not a simple investment. It's not a software company with high margins like NVIDIA stock. It has three parts. First, the legacy business, building hydrogen fuel cells for material handling equipment, namely forklifts. This is its bread and butter, with massive customers like Amazon and Walmart. But this business alone can't justify the valuation. The second part is the Gigafactory, where it builds the picks and shovels of the hydrogen economy, electrolyzers, which are the machines that use electricity to split water into hydrogen and oxygen. This is a high-growth manufacturing play. The third and most expensive part is the hydrogen production itself. Plug is building its own green hydrogen plants, like the ones in Georgia and Tennessee, with the goal of producing the fuel, liquefying it, and selling it. This vertical integration was what was bankrupting the company. It was building the power plants, and the cars, and the gas stations all at once. But now, that $1.66 billion U.S. Department of Energy loan is specifically earmarked for funding this plant build-out, and the 45V tax credit is designed to make the fuel it produces profitable from day one. The business model has been completely de-risked by government policy, which is something you'd never see with Apple stock or Tesla stock. This brings us to the future outlook, which hinges entirely on Monday, November 10th. The expectation is for a loss. The reality the market is desperate to see is a path. The earnings per share number, that negative 13 cents, is almost irrelevant. All that matters on Monday are two things: cash burn and gross margins. The company has been talking about Project Quantum Leap, an internal cost-cutting and cash management program. Monday is the first time we see if it's real. If CEO Andy Marsh reports that gross margins, while still negative, have improved significantly from the negative 66% abyss, that will be seen as a massive victory. If he shows that cash burn has slowed, it will prove that the $1.66 billion loan is a growth level of capital, not just a survival lifeline. This is what long-term investors, the kind that build Schwab Intelligent portfolios or Fidelity Wealth Management accounts, need to see before they would ever consider touching this name. The bull case is that Monday's report, combined with the recent $370 million warrant inducement for cash and the stream of new commercial deals, shows the company has turned the corner. The bear case is that the numbers are just as bad as always, proving that the company is uninvestable at any price, and that the only option left is more and more toxic dilution via its $1 billion at-the-market offering, crushing retail investors who have been making this online investment for years. This is not a stock for a stable Fidelity IRA account. This is a binary event, and it's why sophisticated traders on Interactive Brokers are likely playing the options market, betting on a massive move in either direction. The company's fate is no longer in the hands of lobbyists in Washington. That battle was won. Its fate is now in the hands of its own accountants and engineers. This is a self-investing story that has moved from policy to execution. The entire online investing community is divided. Is this H.C. Wainwright's $7 stock a subsidized national champion of a new energy industry? Or is it a $1 stock, a poster child for a company that simply doesn't know how to make a profit? Plug Power reports earnings on Monday. Comment below with what you think the most important number will be: gross margins or cash burn. We are about to find out if the government's massive bet and the market's $2.65 speculative bet will pay off. In summary, that 5.58% pop to $2.65 on Friday was the final nervous breath before the plunge. The market is at a standstill, waiting for Plug Power's Q3 earnings on Monday. The old story of this company is over. The existential threats of financing and tax credits have been resolved in its favor. The $1.66 billion DOE loan is closed, and the 45V rules are favorable. The expectation is that this is the same old cash-burning Plug Power. The reality is that this is a new, heavily subsidized company that now has to prove it can execute. Monday's report isn't just an earnings call, it's a referendum on the entire business model. The tension is no longer about survival, it's about competence. Disclaimer: this content is for informational purposes only. It's not financial advice, so don't make any decisions without doing your own research or consulting a professional. If you found this helpful, don't forget to like, comment, and share. Stay smart with your money.